A very big stock market crash is getting closer, and a very smart investment expert is telling everyone to do something right away to avoid a big financial problem. According to this smart and the world's richest investor, there will be many opportunities with new developments. Don't miss out on these opportunities because what creates them is when others make mistakes. We don't usually get warnings before a storm, but when Warren Buffett, a very successful investor, suggests that there might be a big financial disaster worse than the 2008 housing crash, it's important to take notice. Let's break down Buffett's warnings step by step and get started without waiting any longer. The allure of risky investments. The world of investing has been changing rapidly. Here's a surprising fact. Currently, an incredible $2 trillion is invested in cryptocurrencies. Let's go back in time 10 years. Cryptocurrencies were almost unknown in the financial world, a kind of experiment that only a few people had heard of and even fewer understood. The journey from obscurity to this huge value has been incredibly fast. So what's causing the immense popularity of risky investments like these? First, there's the dream of getting rich quickly. We often hear stories in the media about people who invested in cryptocurrencies early and turned small amounts of money into huge fortunes. Stories of young millionaires made overnight by investing in Bitcoin, Ethereum, or NFTs have captured people's imaginations. These stories make many believe that anyone can become wealthy, attracting many eager but often inexperienced investors looking for the next big opportunity. Second, it's the curiosity and excitement of exploring something new. Cryptocurrencies, despite their popularity, remain mysterious to many. They represent a new way of doing finance away from traditional banks, and they're governed by decentralized blockchain technology. Being a part of this groundbreaking movement is exciting, even if you don't fully understand how it works. Then there's the bandwagon effect. As more people talk about and invest in these things, the fear of missing out takes hold. Nobody wants to be left out of the conversation or the potential profits. Fear of missing out can cause investment bubbles to grow quickly. However, Warren Buffett, who has decades of investment experience, looks at this situation with caution. He has always advocated for value investing, which means investing in something based off its long-term value rather than its immediate appeal. According to Buffett, the excitement surrounding speculative investments like cryptocurrencies and volatile tech stocks reminds him of past financial bubbles. And like all bubbles, they are at risk of bursting. Buffett's concern comes from the fact that these investments are very volatile. While they can offer huge gains, they also come with significant risks. For instance, the value of cryptocurrencies can change by a large percentage in just one day, which can be unsettling for those who are new to this. Speculative investments, by their nature, lack a history of stability. They are often influenced by market emotions rather than solid fundamentals. When these emotions change, which they often do, it can have devastating consequences. In Buffett's view, the large amount of money going into these speculative areas without a clear understanding of their real value and how they work could trigger a chain reaction in the financial world. And if this bubble bursts, the effects could have a widespread impact on the global economy. It's like if one thing falls, a lot more things will fall too, like a line of dominoes. Warren Buffett's advice is clear. Avoid dumb investments and the rise of selling other people's ideas. The best way to invest is to do your own research and invest in companies that you understand. By following Buffett's advice, you can increase your chances of success and avoid costly mistakes. Soaring or rapidly rising asset values. In the past, the investment industry was dominated by a small number of large institutions. These institutions had access to the best information and resources, and they were able to trade in large blocks of stock. This gave them a significant advantage over individual investors. Today, the investment landscape is much more democratized. Individual investors have access to the same information and resources as the large institutions. They can also trade in small blocks of stock with ease. This has given individual investors a level playing field that they never had before. Buffett is also right to point out that there is a lot of money now in the hands of smart people who are all trying to outsmart one another. This has led to a proliferation of investment products and services, many of which are designed to extract fees from investors rather than generate returns. However, Buffett also believes that this new world will have its opportunities. For example, individual investors can now invest in small cap stocks that were once out of reach. They can also invest in emerging markets and other asset classes that were previously difficult to access. In finance, numbers can tell a story. The story of the stock market's total value in 2021, which was $95 trillion, is quite unforgettable. To put it simply, it's like adding up the economies of all countries, all industries, and all individuals around the world. This huge sum is 125% of the entire world's economic output. This raises an important question. Are these values realistic? Warren Buffett always talks about something called intrinsic value. It means looking at a company's real, tangible worth before investing, instead of being swayed by hype or guesswork. You consider things like how much money the company makes, its growth potential, and how it compares to others in the same business. Now, if we look at big technology companies today, they've changed our lives and have grown a lot. But when you compare their stock values to their actual profits, you'll see some big differences. Some of these tech giants seem to have stock prices that are much higher than what they actually earn. This is what makes Buffett worried. When stock prices go up because of guesses and not strong financial performance, it's like being on shaky ground. Think back to late 1990s when there was a big tech bubble. Everyone was excited and tech stocks reached incredibly high levels. But when the bubble burst, it caused a lot of financial problems. Buffett is warning that something similar might be happening today. The high values, especially in the tech sector, have created a risky financial situation. The problem isn't just a drop in stock prices, but a chain reaction that could affect different industries, regions, and economies. In Buffett's words, it's like a time bomb that's ticking. If and when it goes off, the impact won't just affect individual investors or companies. It could have far-reaching consequences that impact the global economy. Mounting global debts. The world's debt reached a very high $281 trillion in 2022, which is more than 355% of the total global economy. It's like every person on Earth owing around $36,000. This much debt is a problem because it can affect countries, businesses, and people. Warren Buffett is worried about too much borrowing. Debt can be useful for growth, but it's risky when it's not controlled or used wisely. The situation is concerning because nations, businesses, and people are heavily in debt, and the world faces other challenges like rising interest rates and geopolitical tensions. The illusion of endless growth. Some people think that economies can keep growing without limits. In 2022, the world aimed for a 3.5% growth rate despite many challenges. Warren Buffett disagrees with this idea. He thinks that while growth is important, believing in never-ending growth is like chasing a mirage. Continuous growth can lead to dangerous practices. Companies might take big risks, nations could overspend, and investors might put money into unstable businesses. Buffett mentions the housing bubble of the late 2000s as an example of what can go wrong when people believe in never-ending growth. The disconnection from real-world value. The value of assets like companies and digital art is being questioned. Some tech companies are worth more than entire countries. Warren Buffett is worried because he thinks these high values don't always reflect the real worth of these assets. In the past, the value of a company was tied to its physical assets, products, and profits. Today, other things like brand perception and speculative future potential can make companies seem more valuable than they really are. This can lead to problems, like economic bubbles bursting, as seen in the dot-com bubble of the late 90s and early 2000s. Buffett's point is simple. When investments move away from real-world value, they become speculative and volatile. This volatility might offer short-term gains, but can be harmful in the long run. An economy built on speculation rather than tangible value is like a house of cards, fragile and unstable. For most of us, without a lifetime of investing still stretching ahead of us, there is merit in Warren Buffett's rule number 1: don't lose money. In the world of finance, Warren Buffett's advice is a valuable reminder. Even as things change, it's essential to anchor our investments in real value. Think of it as a reliable guide to navigate the ups and downs of modern economics for stability and long-term growth. What do you think about Buffett's ideas? Share your thoughts in the comments.